Hi, everyone. I'm David Silver, CEO of Instrumental Wealth. And joining us this afternoon is Matt Harbert, Chief Investment Officer. Today, we're here to talk about the second quarter and everything that took place in markets and the economy. And Matt, there is a lot to go over and unpack. So let me go ahead and turn it right over to you and we'll jump right on it.
Okay, why don't we go ahead and start with the investment markets? First, looking at broad equity markets. For the first quarter, there's actually been some dynamic changes. In the US, large caps have cooled to a slower but steady positive path. However, small caps have turned negative, making them the worst performing over the quarter. International developed markets slowed down and were essentially flat. However, the surprise was the strong quarter for emerging markets. Emerging markets was the top performing broad equity category, even dethroning US equities. Year to date, however, US equities are still significantly outperforming all other equity markets. The correction over the second quarter in small caps have now turned them to negative so far year to date. Again, the surprise is in emerging markets. After trailing all the other categories in 2021, 2022, and 2023, they are now the second best performing category in 2024 year to date. Even after such strong recent performance, though, emerging markets do remain well off their all-time highs as they're currently just under 18% off their all-time high. Now, if we take a look at the markets in a more expanded view, adding in some other asset classes outside of equities and looking at the sub-styles in equities, U.S. growth does continue to be the top performing asset class, both for the quarter and year to date. Emerging market stocks have come in as the second best performing category for the quarter, and gold has had a good run in 2024. It's up 4.3% for the quarter and 12.8% year to date. That makes it the second best performing asset class year to date so far. Fixed income, unfortunately, is still the worst performing asset class for the year. However, with rates that have been mostly stable over the second quarter, they were able to stay essentially flat over that quarter. US small caps and US value were the worst performers for the quarter. US value at negative 2.3% and US small cap stocks at negative 3.3%. If we look at the sectors inside the S&P 500, really just 4 of the 11 sectors had positive returns in the second quarter. The technology sector led the way with an 8.82% return. That was followed by communications and utilities. All 4 cyclical sectors were negative, as were the sensitive sectors of energy and industrials. And healthcare was also a negative 1% over the quarter. If we look at US large cap performance, as has been the case over the past couple of years, this strong performance has been primarily due to the 7 stocks known as the Magnificent 7. The Mag 7 stocks have had a whopping 31% return for the year, compared to only 7.35% for the remaining 493 companies. According to Y charts, these 7 companies accounted for 64% of the S&P 500's market cap growth for the first half of 2024. And if that's not surprising enough, just 3 stocks, NVIDIA, Alphabet, and Microsoft, are up 49.28% in 2024. Y charts also notes that these 3 stocks have added $2.85 trillion in market cap, where the S&P 500 added $5.8 trillion. This actually makes these 3 companies responsible for 49% of the S&P 500's total gains. The impact of these 3 stocks is a result of 2 factors. One is strong stock performance, but the other is their market cap. The S&P 500 is a market cap weighted index, meaning the higher the market cap of the company, the bigger its portion of the index. You can see by looking at this scatter plot that those 3 stocks may not have the highest returns compared to all of the other Mag 7 stocks, but they're close to $1.5 to $2 trillion larger in market cap. Interesting, Tesla has actually been a detractor to the remaining 4 stocks, And there's actually even been some argument that they no longer belong in this group. So this has led to heavy concentration in the indexes. Looking at the chart on the top right, you can see that the weight of the top 10 stocks in the S&P has been significantly increasing. It's now reached close to 40% of the index. The bottom right chart shows earnings contribution of the top 10 stocks. This actually has been growing, so there really is some fundamental justification to the concentration. However, the negative to this is that valuations have also gotten much higher, which you can see in the chart on the left. The question is, will this trend continue? So getting back to earnings. As mentioned, earnings led some justification to the outperformance and concentration of these companies. Looking at earnings growth forecasts on this chart, we can see two things. First, the earnings growth for the Mag 7 companies are expected to trend downwards. Second, earnings growth for the remaining 493 companies are expected to increase and match the Mag 7 by the end of the year. So this scenario would favor a broadening out of the index. So a combination of the outperformance as well as the strength of the US dollar has also impacted the exposure of the US in global market indexes. If you look at the top line on here, the gray line shows that back in 2010, the US was around 40% of the all-country world index, and it's now become 64% of the index. Developed markets of Europe and Japan have moved from about 30% in 2010 to only 17% currently. And finally, looking at emerging markets, they've fallen about a third from about 15% back in 2010 to only 10% of the index now. So that would be the end of the investment market update.
And that was great. I mean, I think there's so many things there that we all have heard, but just to see it laid out that way, I know is super helpful. That was fantastic. I think let's transition into talking about the economy next. I know that was a great update on markets. Perhaps you can shed some light into the economy and what's taking place there.
Sure. So turning our attention to the US economy, I do want to focus on 5 areas: employment, the consumer, inflation, Fed policy, and the possibility of a recession. So starting out with employment. So overall, employment is normalizing, but still remains elevated. Looking at payrolls, we have added an average of over 177,000 jobs per month in the second quarter, and over 222,000 per month in 2024 year to date. This is a pretty robust number, especially looking at the 10-year average number of jobs added prior to the pandemic was only 90,000 per month. Unemployment, though, has started to rise. It's at 4.1%, which is up from a low of 3.4% last year. Now, that still is below the 10-year average of about 4.77%. Looking at the left side chart and focusing on the labor market, there was a slight uptick in job openings and hires in May. However, we think the overall downward trend remains intact and have fallen quite a bit since their peaks. Quits have also leveled off in the second quarter, but also remain well below their peaks. When we look at the ratio of job openings per unemployed worker, it's telling a similar story. The trend is normalizing. However, with 1.2 jobs available for each job seeker, we've not reached that level where seekers are having big concerns over the ability to remain or replace employment. So moving on to the consumer and looking at spending strength. So spending has been resilient. However, there's been a definite slowdown over the recent quarter. Retail sales that you can see on the top chart were flat in June. And the bottom chart showing overall personal spending was still positive. However, for personal spending, we only have the numbers as of May, as June results will be coming out later this week. Now, as we've discussed in the past, spending has been supported by debt and savings. Looking at this chart, the orange line shows how revolving credit, which is primarily credit cards, has taken off since mid-2021 as the economy has been emerging from quarantine. And the savings rate, which is the personal line, the purple line, has come way down. So this was sustainable at low interest rates. But has the recent high interest rate environment had any effect on this? So it does appear that we're starting to see some stress. Delinquency rates for both credit cards and auto loans have been rising. Levels aren't quite where they were back in early 2010, so it's not a severe problem yet, but these levels are rising. Now, note that this is more of a problem for the lower income earners, as a large portion of these delinquencies are concentrated there. But the top quintile of earners account for just as much spending as the bottom three quintiles combined. So while delinquencies will be a headwind to consumption and a friction to economic growth, it may be to a lesser extent than is typical. Now, looking at inflation, the story here is after coming in surprisingly high over the first quarter, the trend to falling inflation resumed over the second quarter. Several key areas are seeing improvements. First, if you look at the headline, you can see the top line there has a heat map on it where red is higher inflation and green is lower inflation. You can see that it ramped up to 0.4% in March, then started decelerating each month, where June actually had a slight deflation. The driver for this really was falling prices at the pump. You can see also the row for gasoline also ramped up, and then starting in May, we had deflation of 3.6% in May and deflation of 3.8% in June. Although the trailing 12 months is still elevated, but it has been coming back down. So looking at the core, there has been overall deflation in core commodities. However, the primary concern to policymakers has been in the services sector. Core services, the stickiest part has been in the shelter category. This has had a lot of impact as it accounts for over 35% of the index. May and June finally indicated some thawing out here. So while the trailing 12 months remains highly elevated at over 5%, it does appear we're starting to move in the right direction. So Fed policy, the Fed did complete their hiking cycle last July, leaving the target range at 5.25 to 5.5%. And they've been on hold since then, while speculation has been that they would start cutting rates this year, initially forecasting 4 to 5 cuts beginning early to mid-year. However, with inflation heating up in the first quarter, really those expectations have been changed to 1 or 2 cuts this year and beginning later in the year. So when do we think the first cuts will start? Well, the FOMC meeting is next week. We think it's pretty unlikely that they'll cut rates at that meeting. But what about the meeting in September? So looking at the FedWatch chart, you can see the markets are actually pricing in a high probability of a rate cut in September, pricing in about 90% probability of that cut. So outside of inflation surprising on the upside, we do actually think there's a good chance they will start easing in September. Looking at economic growth, so the GDP results show that growth has been cooling. We can see much of the effects of what we've discussed and slower spending and higher interest rates in the growth numbers. They peaked around the third quarter of last year and have been slowing ever since. The first quarter of this year is actually quite a bit lower than anticipated, coming in only at 1.4% annualized rate. This actually was the lowest rate since June of 2022, when growth fell negative. So looking at the bottom part of the chart, we can see the contribution of consumption in this, and that really has been the driver of this slowdown in growth. So you can see consumption overall came in at only 1.5% for the first quarter, and if you look at the bottom chart, you'll see that consumption has been a pretty big contributor overall, coming in about 2.5%, 2% through the 3 of the last 4 quarters. but in quarter one, it fell to under 1%. So going forward, looking at what might be going on in the second quarter with GDP, well, this is the GDP Now forecast. It's a model that is put out by the Atlanta Fed. And by the end of the quarter, that fell to 1.7% forecast of the second quarter GDP. Now, recent updates since this chart have had some better information that come out. So they have bumped that up to 2.7%. As far as probability of a recession, so this chart shows various recession indicators, and they are mixed. However, for the most part, they are signaling a caution and not an outright recession. The first number is the yield curve. So basically, looking at an inverted yield curve, once it inverts, it generally predicts there's going to be a recession over the next 12 to 18 months. Yet this has been inverted now for 24 months. So the yield curve is definitely flashing a deep red. But moving on to the LEI index, that previously did signal a recession, but with numbers improving, it has moved out of there and is only at a warning level right now.
And Matt, LEI is leading economic indicators, correct?
That's correct. That's correct. So there are various indicators that they use that really are predictive of future growth in the economy. And so this is a handful of those indicators that they put together, create an index out of it. And so they're looking at kind of the duration and depth overall as far as those indexes, and then I'll come up with whether it's predicting a recession, a warning, or nothing. And previously it was saying recession, but now it's gotten a little bit better and it's moved back to just a warning.
Thank you.
Mm-hmm. Then the next one down is the SAM rule. So the SAM rule is actually a very accurate measure of recession, which is based on the unemployment rates. It's essentially saying that the current 3-month moving average is more than 0.5% above the lowest 3-month moving average over the past 12 months, then it predicts an onset of a recession. So currently it's at 0.43%, which is only 0.06 away from a recession signal. So it's very, very close, which I would look at as a warning, but it's not yet at the point where it's predicting that outright recession. So next is the Chavette and Piger. This really is only predictive when it's above 80% for 3 consecutive months. Right now at only about 0.25%, it's not even close. So this really isn't predicting a recession at all. It's neutral. Finally, we have the Estrella in Michigan. This uses the slope of the spread between the 10-year and 3-month Treasury rates. So it actually is giving a higher than average probability for recession, but not extreme yet. So it's currently at about 55%. So that would put us in warning, not imminent recession coming up. So really, when you look at these all together, it really isn't saying that that we're predicting a recession over the next 12 months. Just kind of more cautious, want to keep an eye on that. But right now, we're not predicting a recession in the near term. Also, Fidelity actually puts out a nice chart. It shows where the economy is in the business cycle. You can see Q2 on here for the US, showing we're just entering the late stage of the cycle. And they actually readjusted this. So last quarter, they had us further on in the late part of the cycle. But as things have improved and looked a little bit better, they actually backed that up a little bit to being a little bit past the mid-cycle. And this actually is pretty consistent with what we are seeing. It's in the later stage where growth is still slowing. We're starting to slow, yet there's still a little bit of room left before a recession hits. That also basically does not predict an immediate recession. So that really is our update for the economy.
That's great, Matt. Such great pieces of information in there. I know our clients really appreciate hearing from you and getting a lot of those details. Let's wrap up with talking about sort of the key takeaways from all of this and things that we're paying attention to and clients should take away from this presentation.
So first, looking at employment, labor markets continue to normalize, but have not softened completely. There's been a robust number of new jobs added each month, although unemployment has risen, yet still is at historically on the lower side. The consumer is holding up, but also cooling. And with higher interest rates, we are starting to see some impact to the consumer as we're getting some higher levels of default rates in credit cards and autos. With inflation, after an unwelcome surprise of higher prices in the first quarter, the downtrend has started back up again. And finally, we're seeing some relief in the shelter categories of the CPI. With Fed policy, we've got normalizing in the labor markets, consumption is slowing, inflation is falling, and the economy overall is cooling. So that should be getting the Fed a little bit closer to the confidence they need to start easing. While we don't expect that cut in July, we do think there's a high probability of a cut in September. GDP growth and a recession. So we are seeing some effects from higher interest rates. There's been a slowdown of the growth rate due to falling personal consumption. However, recent projections have looked a little bit better, but still on the lower side at 2.7% annual rate forecast for the second quarter. Recession is not the highest probability in the near future. It's looking more like maybe a soft landing could occur. Indicators reflect the softening of the economy. However, they're not firmly in that. They're firmly in the cautionary territory, not really telling us imminent recession. The U.S. is in the late stage, which leaves some room for growth to continue for a little while. Looking at markets, U.S. growth equities continue to outperform. Concentration in the U.S. large cap does continue to be a problem and has risen over the second quarter. However, when you look at earnings between the more concentrated holdings and the remaining part of the indexes, they are expected to normalize a little bit, which suggests the broadening of the index could start occurring. And lastly, we are also seeing some concentration in the international indexes to the U.S., with the dollar improving and the outside domestic performance as causing that.
Matt, that was excellent. Thank you so much for preparing all of this great content for those that are watching this. If you're watching this and you've got questions or want to dive deeper into this, please contact your advisor. Hop on our website at instrumentalwealth.com. Schedule some time with your advisor. We'd love to answer any questions that you have on this. And as always, Matt is available for our clients if you want to reach out to him directly as well. Appreciate everyone's participation in watching this and look forward to hearing the update in the third quarter. Thanks again.